And now, The Money Show with Motheo Khoaripe
on 702. Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa CIB. Discover the latest trends shaping digital assets across Africa. Download the Absa Africa Digital Assets Insights 2025. Good evening. Welcome to The Money Show. My name is Motheo Khoaripe in for Stephen this evening. Look, I'm all rained out. I'm really all rained out, so we won't be talking about any of the weather that we're experiencing in Johannesburg right now. It's just chatting money. Tonight we're going to be covering the African Continental Free Trade Area, something introduced in 2018, but as President Cyril Ramaphosa said yesterday in terms of his visit to Mozambique, it's something that African countries should be taking advantage of. All those years later, is it something that we still need to be talking about? We'll be talking to Dale McKinley, the Dr. Dale McKinley, political economist, about how the free trade area is changing trade on the continent. Is it just too slow at the moment in terms of implementation? Then we look at the country's business confidence index coming through with better results, especially before the year closes. RMB chief economist then Isaah Mhlanga will join us for that conversation. Chris Stewart will cover markets for us tonight, looking at some of the results that came out on the JSE. But not only that, looking at the US, because the US Fed is set to set interest rates, and we'll see how that will affect our local economy. It is a time for gifting. And for those with children, nephews, nieces, they'll know the stress of looking for gifts, especially at toy shops, because the prices are quite high. South Africa is a 6 billion rand toy market. We'll be talking to Toys R Us this evening. Catherine Jacoby, marketing manager at Toys R Us, will talk us through their strategy for this festive season. Then the wheels of rail reform in South Africa seem to be turning, but turning slowly. Traction, a company that's in the private sector providing locomotives, has invested 3.4 billion rand to try and improve South Africa's freight rail. We'll be talking to Traction CEO James Holly later on the show. And when you do your banking transactions and you click on immediate payments, are you aware just how much you are being charged and what options you have outside of those charges? We'll be talking to a consumer ninja, Wendy Nola, about some of the rights that you have and what to look out for if you don't want to lose your money while transacting on your app. Later on the show, our shapeshifter tonight is FNB CEO Harry Kellan. Talk to us about his career and his journey throughout the financial sector. All that and more on The Money Show. Let's talk money.
The Money Show
with Motheo Khoaripe
on 702. Let's walk the talk.
Well, President Cyril Ramaphosa recently called on South Africa and Mozambique to take advantage of opportunities presented by the African Continental Free Trade Area to achieve sustainable development and inclusive economic growth. Now, it's not the first time we hear something similar. The African Continental Free Trade Area is, of course, a trade agreement to create a single market for goods and services across 55 of the 55 African Union member states, covering a market of around 1.3 billion people on the continent and a combined GDP of around 3.4 trillion rand. So there are opportunities there to take up, but it seems every time there's a bilateral meeting between African member states, it's always something to punt the African Continental Free Trade Area, but very few of them are taking it up. And I want to get into this conversation later with Dr. Dale McKinley, a political economist, just to look at how good this policy is and whether there's been much take up since it was introduced in 2018. I know countries like Algeria, Cameroon, Egypt, South Africa, and Nigeria as well have gone into starting to trade under this particular policy. But is this something we can fast track in order to boost trade on the continent? But before that, we get into business confidence in the countries, though those numbers looking far, far better following two consecutive quarters of declines. The Rand Merchant Bank and Bureau of Economic Research Business Confidence Index rising by 5 points to 44 in the fourth quarter of this year, putting confidence 3 points above its long-term average. Isaah Mhlanga joins us now for that conversation. He is the chief economist at Rand Merchant Bank. A gift for the South African economy, business confidence looking up. Another one of the positive numbers that have come in more recently around the South African economy.
Indeed, there are three things that I think are important. The confidence is up. The second one is it's broad-based, with 5 of the 6 sectors rising. Even the sector where sentiment declined, which is building contractors, activity did not decline. And sentiment is close to its long-term average. And then the third one is we are above the long-term average on the overall business confidence index.
And some of the factors driving that improvement, are we looking at interest rate cuts? Are we looking at some of the, positive data that's come out more recently, the ratings from S&P Global?
Look, it depends. It differs from subsector to subsector. If you look at the manufacturing sector, for instance, with the largest increase of 16 points to 39, and then you have new vehicle dealers that rose 4 points to 58, the only subsector to have the majority of respondents above 50 or that are satisfied with prevailing business confidence. And then you can also look at retailers up 11 points to 43, and then the wholesalers also up 4 points to 42. Those subsectors don't have different dynamics, but overall, it is low inflation, which has helped. It's lower inflation target that has now officially been announced by Treasury, and the SARB is now targeting a 3% inflation target. But also it is interest rate reductions that we have seen, but also that we expect as we move into next year. Is the credit rating upgrade from S&P? Is the decline in debt servicing cost that we have seen, post the MTBPS? All of those things have been positive. And yesterday's print in GDP does confirm this as well, where it rose by 0.5 percentage points, the fourth consecutive quarter of positive growth, but also one special thing out of this release that aligns with the improvement in business confidence. Gross fixed capital formation rose for the first time this year. That says we have turned the corner. The trajectory is positive, even though it's not yet at a pace that we should celebrate.
I wanted to get into that capital formation because that GDP number that came out yesterday shows that there's some investment that's coming in from the private sector. And I guess the business confidence numbers are also in line with that, with around 44 or close to a half of respondents this time around saying they're satisfied with current business conditions. And we know when business leaders and CEOs and managers are confident about the economy, they're going to invest a little more in their businesses.
Indeed, but it's not yet time for us to celebrate.
Hold the champagne.
Absolutely. Let's hold the champagne. Let's put it in the fridge. We still need to see a bit more done from a reform perspective, particularly on the logistics sector, the water sector, the municipalities, as far as they deal with infrastructure, because that is ultimately where businesses reside. And the difficulty in licensing, in getting permits, in road infrastructure at that level of operation is actually what impacts on business operations. So we need those to continue. Without those, we are unlikely to see a sustained improvement in confidence, which is so critical before we can expect a boost in fixed investment and economic growth.
There's a lot of confidence from retailers, a lot of confidence from wholesalers. But when you look at the high power tariffs in the country and the high price of electricity, should there be some risk or concern for those that are in manufacturing and are using a lot of the country's power?
Look, electricity availability is one, but also electricity affordability is the next big issue as far as energy is concerned. If we don't have a competitively priced electricity sector, even if it's available, it means it's going to be just costly with many other repercussions elsewhere in the economy. For instance, inflation will remain structurally high. If we don't have efficiencies in some of these sectors, such as electricity and logistics, which would then mean the cost of funding structurally driven by the high inflation will also be higher. So it's absolutely important to have a cheaper electricity prices for many of the manufacturers so that they can be also globally competitive.
Then when we look at just how the year has played itself out, it's been quite choppy, this trade situation and shifts that we've seen them play out between the US as well as South Africa. That's been the major story, really. And look at those, geopolitics that have also put pressure on emerging economies like South Africa. As we wrap up the year, are we to look forward to a far more positive 2026? Set aside the G20 meeting, but just on a broader economic side, is South Africa turning the corner here?
Look, South Africa is turning the corner. That's our assessment. And even if we take into account the G20, this year, it has been a success. For the first time, you have a leaders, declaration that is reached before the actual leaders summit. That has been positive. Bar the absence of the US, everything else, in our view, have been positive. But if you just look at the developments generally, growth is better this year relative to last year. Inflation is lower this year relative to last year. Interest rates are lower this year relative to last year. We have seen a continued positive growth for 4 consecutive quarters.
Sure.
We have seen the first upgrades from a credit rating that is not our doing, an external rating for the first time in almost 20 years, saying we are seeing positive developments, we are seeing improvement in reforms, and therefore we are happy to upgrade you.
So a lot of positivity then going into 2026. That was Isaah Mhlanga, Chief Economist at Rand Merchant Bank. South Africa turning the corner ahead of 2026.
The Money Show will give you all the tools you need to navigate the complicated world of economics and commerce, even if you're not a numbers person. The Money Show
with Motheo Khoaripe,
6 to 8 p.m. Making money make sense
on 702 and Cape Talk.
Very interesting story coming through here. Around a 3.4 billion rand rail investment that's going to be going into helping Transnet improve efficiencies in the country. The rail and logistics firm Transnet has opened its rail network to private operators to improve its efficiencies and deliveries, and it seems the interest has garnered some investments already. A company called Traction coming through from New Zealand, ready to be part of this. Economist CEO James Holley joins us now for this particular interview. 3.4 billion rand is not chump change, James. And why did you feel this was a perfect opportunity for Traction?
Motheo, thanks, and thanks for speaking to me tonight. We are a 38-year-old rail freight operator that operates our trains currently in 10 countries outside of South Africa, but we are a South African business at heart. And so the operation of trains on the continent is something that we understand very, very well. We've also been very involved in the process of public consultation on the implementation of these really groundbreaking reforms for the South African rail sector. And, I think this is a real big vote of confidence where we're saying that we're happy with the direction of reform. We're happy with the policies that have been implemented and the enabling legislation. And we're ready to make an investment off the back of that. The trains that we're buying are coming from New Zealand, and we're acquiring them from KiwiRail, who's replacing their fleet of Wabtec locomotives with a new generation of low emissions trains. And it was also a pretty rare opportunity in the Cape gauge environment. We operate in the region in a narrow gauge, for us to get our hands on a large fleet, but a fleet that's in very good condition. So the two factors came together. It was an opportunity at a time that we felt we had the confidence to invest in South Africa.
You would have assessed this particular deal, and what's in it for you, if one were to ask quite frankly?
Well, this is going to be an extremely high a fleet with a very high reliability and a fleet with a very high capacity. We are going to be firstly buying the locomotives, and then together with Wabtec, who are the original OEM and who are widely regarded as the world's preeminent diesel electric locomotive manufacturer, going to be doing a significant upgrade program on the locomotives. And the outcome of that is going to be a very high capacity and high reliability locomotive, but one that we can deliver to the industry in a very short period of time and at a very cost-effective price. So what's in it for us is effectively to be able to bring to South Africa for the first time private rail freight services and private rail freight services on a very cost-effective basis.
You would have looked at this particular deal structure and some of the infrastructure that South Africa has. Is it going to take time to match the locomotives coming through from New Zealand, or to have the similar technology in terms of infrastructure, and it will be easier to roll them out?
We already have about 12 of these locomotives operating in our fleet with pretty much identical technology to what we're ultimately going to be left with post the upgrades, and that's part of the fleet that we're operating outside of South Africa. We have 55 locomotives in our existing fleet, which is the largest private fleet on the continent. So we know the technology very, very well. It's also very, very similar to technology that Transnet has in their fleet. So it's a type of locomotive technology that is extremely well understood by us and by the downstream services industry that services the key components in these locomotives. So, we're very comfortable with the technology we're bringing in here, and we've got a very high degree of confidence that it's going to be successfully rolled out.
This is a great opportunity then for South Africa to improve, of course, its efficiencies and, lead times in terms of delivery for exports and things like that. We see the opportunity there. But I know South African unions will be asking around the local content and just how many jobs will be created off this particular exercise.
Okay, so we're going to be placing about 79% of the total value of this contract is going to be placed with South African companies. If you look through that, about 60% of that is going to translate to local content. So, not only is this an outstanding story for the upstream economy, where we're going to be solving about 5% of the freight logistics shortfall in the country. The Transnet on an annualized run rate basis moves somewhere between 160 and 165 million tons. The rail freight demand in the country is 250 million tons. And Minister Khoaripe has said that she has set a target for the industry to meet 250 million tons by as early as 2030. So, firstly, we're solving a portion of one of the big constraints to economic growth in the country. But also, the project itself is also outstanding for the South African rail industry. We've had a look at this and engaged with our customers. And we believe there's about a 5 times multiplier for every job that we create. So our project in traction is going to create 662 jobs. There's about a 5 times multiplier into the upstream economy. And then into the downstream economy, where we're going to be procuring the wagons, where we're going to be sending the key component parts of these locomotives for services. There's, of course, further job creation in addition to that. So I think on all fronts, really a great project for the country.
Traction operates across 10 African countries already. Are there going to be any connections? I'm kind of thinking about the different trade between countries here in the region, the likes of Botswana, Mozambique, Lesotho. Are we going to see any tracks connecting between the two in terms of trade?
Yeah, that's something I'm really passionate about, Motheo. If you go back about 7 years ago, we had the right to operate our trains in one country outside of South Africa, and that was in Mozambique. And today, we have the right to operate our trains in 10 countries. So the same reforms that South Africa has rolled out, which is really allowing the private sector to bring trains and take up the latent capacity on a section of rail track on the national network and to pay access charges like toll fees for using it, is a policy that's been rolled out regionally and has been rolled out at speed and has been rolled out to almost all of our trading partners. And that's why we operate in all of those countries now. So the opportunity for private trains to operate from South Africa into the region exists now that didn't exist in the past. And it is something I'm quite passionate about for the future. These trains, though, these 46 locomotives and 920 wagons have been earmarked initially for South African customers. Yeah. But I am really optimistic about what it means for really efficient regional trade into the future.
And when will the train wheels hit the track?
The first locomotives will be available for service within the next 12 months, which is also a really exciting part of this project because the timeline for the delivery of new locomotives from the time that you pay your deposit is typically 24 months. So to have locomotives in service as soon as this time next year is also a pretty good part of this project.
All right, that was the CEO, James Holly, the CEO of Traction, a company coming up with 3.4 billion rand rail investment, signaling the confidence in South Africa's rail reform. Thank you so much for joining us here on The Money Show.
The Money Show.
The markets.
Let's have a closer look at those markets and how things ended on the JSE. The all share up 496 points, pushed up by banking stocks, which were up more than 1%. Covering our markets today is Chris Stewart, portfolio manager at 91. Chris, great chatting to you again. Voluntary update from Nedbank. They were talking about just how tough a year it's been, this 2025, but looking forward to a better 2026. Your assessment of their numbers?
Yeah, good evening, Motheo. We've got a trading update out of Nedbank, following up from a FirstRand trading update, and indeed a Standard Bank trading update earlier in the week. And we will be hearing from ABSA on Monday of next week. And, a difficult period, I think, for all of the banks, as they've indicated. But, dare I say it, things starting to look a little bit better. Certainly much more optimistic about the outlook for 2026. We're starting to see corporate credit growth come through. Interest rate decreases are starting to open up a little bit space in the consumer wallet to increase borrowing. So we're seeing increased borrowing across particularly the vehicle and asset finance space, as well as the mortgage market starting to show some signs of life. Improved credit quality, also assisting the bottom line for the banks, and some indications that transactional activity is starting to improve as well, all of which bodes well for earnings into next year. And, markets being forward-looking animals, and with the banks having lagged the markets quite significantly thus far this year, despite the bond yields rallying very, very sharply, which are typically good for bank valuations and typically good for the relative performance of banks. They've been relatively poor. Earnings prospects looking up, and as a result of that, we're seeing the banks starting to go a little bit better. Nedbank included in that pack, despite the fact that they've got some idiosyncratic headwinds. They owned a business called, or 20% out of a business called EcoBank, which is a Pan-African banking operation. They've sold that. That's going to leave a little bit of a hole in their earnings both this year and next, which means their earnings growth will lag the peer group somewhat, but also showing some signs of life in terms of those indicators that I talked to.
And there's that painful number of the 600 million rand one-off expense related to the commercial settlement with Transnet. How much will that be a pain then going into next year?
Yeah, I mean, that will have no impact on next year's numbers. They're going to expense it all this year.
Yeah.
Depending on the tax status of that expense item, it's going to hit their earnings by, somewhere between 2.5% and 3.5% for this year, which will take the wind out of this year's growth, I guess. But equally well, if it is a price that they need to pay in order to, repair their relationship with Transnet, given the amount of infrastructural spend Transnet has flagged at sort of 25 billion rand a year for the next number of years, it should pay dividends to get that relationship back on track, as Nedbank, within their corporate and investment banking business, can start to get their fair share of Transnet's business into the future.
Let's jump then to those U.S. numbers. The November private payrolls unexpectedly falling by 32,000. That number ahead, of course, of the last Fed meeting between the 9th and the 10th of December. Do you think this will have another nudge towards an interest rate cuts in the U.S.?
Yeah, I think it must have a nudge. There's been plenty of talk in recent weeks and a little bit of nervousness that the rate cuts that perhaps a month ago had been discounted as almost a certainty in December was somewhat less likely. A number of the Federal Reserve Committee members had made some discomforting noises, particularly around inflation in the US. So, ironically, we're in a position now where short-term poor macro data points and a jobs number being a particularly relevant one is actually probably quite good news for markets because it increases the likelihood of a rate cut. And we all know that equities tend to respond favorably in the short term to lower interest rates. So, poor macro data a poor macro data point out of the US today means perhaps a greater likelihood of a rate cut next week, and that's been relatively positively received by markets.
Then when we look at the numbers that came out in South Africa, one, a good number, looking at the business confidence, which we chatted about earlier on the show. Another, a worrying one, looking at the manufacturing sector. In fact, the second PMI number to come out this week, talking about weakness in that sector.
Yeah, I mean, given that we're into the festive season and we need to be glass half full rather than glass half empty, I guess we can say that the negative data point is a backward-looking or, at worst, contemporaneous data point, whereas the positive indicator is more of a forward-looking indicator. And I think that's probably describes where we are in terms of SA macros right now. It's been a difficult year. It's been a year of subpar growth. Yeah. Nonetheless, we've seen some signs of positivity. We've seen ratings upgrades coming through. As you mentioned earlier, we're off the fat of grey list. We're seeing increased business confidence, and we're seeing some increased green shoots in terms of credit extension. So, roughly consistent with what we've been seeing, and hopefully indicative of a better year to come in 2020.
Good wrap of the markets. Chris Stewart, portfolio manager at 91, joining us for that conversation. Thank you very much.
702 and Cape Talk.
Motheo is on X
At Motheo_Khoaripe.
Most of us never really think about toys until you go shopping with your little ones and they tug at your hems, trying to get you to buy more toys. And of course, we're closer to the festive season, and this is where that money starts rolling in. South Africa's toy market at between 6 to 7 billion rand. Look, a lot of those kids are terrorizing a lot of households, I'll tell you, and a lot of swiping is happening to buy some of those toys. We're going to chat now to Catherine Jacobi, marketing manager at Toys R Us. Catherine, welcome to The Money Show.
Thank you. Thanks for having me.
I suspect it's not just the little ones are buying these toys. There must be a whole lot of more adults that are still feeding the kids inside of them.
Absolutely. I think we all never really grow up. Whether that's public or secretly you have a stash of Lego or Hot Wheels cars in your house somewhere, but we always are kids at heart, and I think that never ends.
When you look at the market this year, a lot of sectors in the country have talked about how tough it's been. The consumers are not going into discretionary spending. They're trying to keep their pockets and purses shut. How has it been for the toy sector?
Yes, we obviously do see the impact of the state of the economy, and customers are looking for that affordability and a solution that offers value, but still a developmental play pattern so that their kids are still engaged and playing with toys. But we do ensure that there is a range of products that can suit any budget. And the good thing about the festive season and gift giving is that it is an emotional purchase. So it is a resilient market, and no matter what the pocket is, there is something for everybody. And like I said, it's an emotional purchase, and gifting is still on the radar, no matter if this year it's slightly less than the year before.
But there's a lot of competition now. If you look at online gaming and all sorts of things that we can now do on our phones, how are you remaining competitive, even as a Toys R Us, with that type of market where a lot of the consumers have a lot of choice? How are you getting their attention?
Yes, it is a very competitive market, and I think as Toys R Us, we firmly believe in the power of play and how play plays a fundamental role in the development of children. So we're very pro screen-free play, and I think that also plays into the minds of parents these days is, are our kids spending too much time on screens? There's definitely a place for it, and we sell that sort of product, but there is still a demand for original and sort of nostalgic play patterns that have got various benefits to playing with those toys, whether it be connecting with family members through a game of competitive Uno or Monopoly, or it is role play, building up the shopping basket and mimicking what your mom and dad do at the grocery store. So I think as much as that we are seeing tech and gaming peaking more in the tween category, we do still see core play patterns and toy categories performing very well, especially in the younger generations.
And do those old tricks still work? Putting toys at the point of sale, making sure you can drive up those sales, or maybe connecting it to a series of toys, or maybe using movies as well to try and push some of these toys.
Yes, we definitely see the pester power play a big part. So like you mentioned at the beginning, that tugging on mom's leg at the shops definitely plays a part. But we do take a lot of inspiration and direction from our global intelligence, and obviously combining that with entertainment or movie releases, and then also monitoring social platforms. I mean, you can have one product that can become viral overnight, and it's about managing that demand and obviously not over-investing in a product that has seen a sudden peak, but being able to ensure that you do have a supply in the pipeline that you can pull on. So we've got to monitor what is happening globally and then blend it with what our local market requires. And that sometimes is affordability, or it might be a local trend that we need to pick up on. But you do see a bit of both. So the parents obviously looking at what's available in the pocket, and then the child is pulling on what their peers are wanting or what they've seen on the TV.
Well, good luck to most of us who'll have to try and keep our purses shut as the kids cry for the toys. That was Catherine Jacobi, marketing manager at Toys R Us, talking about a very strong South African toy industry at the value of 6 billion rand.
The Money Show, Stephen Grootes, is brought to you by Absa CIB. Discover the latest trends shaping digital assets across Africa. Download the Absa Africa Digital Assets Insights 2025.
Welcome back to the Money Show. Just some of the important numbers that came through today. The RMB-BR Business Confidence Index rising by 5 points to 44 in the last quarter. Almost half of respondents are satisfied with current business conditions. Confidence improving in 5 out of 6 sectors surveyed. The manufacturing sector also seeing a significant improvement. Now I want to talk about the African Continental Free Trade Area. There's something that the president mentioned during his visit to Mozambique, that both Mozambique and South Africa should try and use the African Continental Free Trade Area to do more business together. I mean, this is something that was launched in 2018. We're going to try and see just how much it's worked since it's launched, because the take-up has been quite slow. Dr. Dale McKinley, political economist, joins us for this conversation. Dr. McKinley, looking at the president's comments around neighboring countries using this particular policy, is it something that has been taken up by most African countries? Because if you think about it, 2018 is a very long time ago.
For having me. Listen, it's, the take-up has been, as you mentioned, very slow. And I think the main reason for that is because most African countries have yet to understand that, lowering barriers to trade, and particularly not just trade as in goods and other things, but also human capital, is necessary in order to make that's what a free trade area is. It's not simply about private sector investment and opening the doors. It's about trying to have a developmental agenda. At least that was what the theory was, and to try to lessen influence on global markets, particularly Northern Europe and the United States and others, which we've been historically quite dependent upon, and to try to grow our own markets, and to do so in a sort of developmental way. In other words, creating jobs and stop stemming the flow of economic migrants as well, which is a huge thing. And on both counts, it's not just been slow, it's actually been quite a bit of a failure. I mean, what you mostly have is you have bilateral relationships, as you saw with the Mozambique, South Africa one earlier on today. And that's been the sort of nub of it, yeah.
I mean, less than 20 countries, following countries are actively trading under the framework, particularly through the guided trade initiative, the likes of Algeria, Burundi, Ghana, South Africa, Nigeria, Rwanda. Is it a matter of political will, or maybe this infrastructure is not available yet to practically have the trade happen?
Well, look, the infrastructural challenges are always there, and that certainly can be improved. I mean, one can look at ports and rail links and other kinds of, and of course, our continent is probably the most expensive in terms of air freight and air travel. So yes, these are things that need to be improved. But I think that the predominant issue is politics. And it's we've entered in, I think since, COVID in particular and the rise of Trump and the sort of narrow nationalisms and, our country first kind of agenda, what we've seen is sort of a scaling back. There's a lot of good rhetoric. You see it in the African Union. You see it in some of the other regional trade areas. But the practical reality on the ground is when you don't have a situation where you have economic stability and political stability, you can't have trade stability. And you can't have markets. So that's the question. The issue is we can talk economics, but unless we talk politics at the same time, we're not going to solve these issues. And in our continent, politics tends to trump economics most of the time.
And it's keeping us back. That's Dr. Dale McKinley, political economist, talking about the African Continental Free Trade Area and the slow take-up of that particular policy that could have Africa at a combined GDP of $3.4 trillion.
And now, The Money Show with Motheo Khoaripe
on 702. Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa CIB. Discover the latest trends shaping digital assets across Africa. Download the Absa Africa Digital Assets Insights 2025.
The Money Show.
Consumer Ninja.
Just a little after 7 here on The Money Show, and around this time every Wednesday we have your Consumer Ninja and Wendy Nola fighting for your consumer rights, one case at a time. Wendy, welcome again to The Money Show. Now, I'm that kind of person, when I transact and I want to send somebody money, I usually press immediate payment. Of course, that comes at a charge, and I would rather have that happen than it being delayed over a couple of days. But as consumers, we still have that option, right? That you want to opt out of being charged extra, but it seems some banks aren't doing that.
Yeah, hi, Motheo. This was quite an intriguing case to me. This is what listener Jean told me in an email. She says, I could not understand why my bank charges with my Absa account were suddenly so high. I then discovered that all my payments were being charged as PayShap, that's immediate, at R7.50 per transaction instead of R1.50 for the regular payment, which takes a day or two to reflect in the recipient's account. On closer inspection, she's told me, I have now seen that the Absa Bank app starts with you selecting normal payment, for which the charge is R1.50, and she actually sent me a screenshot showing this. She says, but the moment I enter in the amount, the default goes to PayShap without any request from myself. In other words, automatically overrided. She says, and she sent me a screenshot to prove that. She says, and then it goes to confirm payment, and it's only on checking now that I see I've been sending a PayShap, which is set as the final method of payment.
Now, PayShap, of course, is a digital payment platform that allows users to send and receive money instantly, right, between participating banks. I think FNB, Absa, and some of the top banks in SA use PayShap as well, right? But you can still opt for just the normal transaction without the R7.50.
Indeed. So, admittedly, what I could see from the screenshots that John sent me is that as she went to press pay, it did say next to it PayShap. It didn't say the price, just said PayShap. But in her mind, she has been choosing normal payments. She has been actively selecting it for herself. So she's not thinking that that's been overridden or changed, okay, by the price. She's just, okay, it's a normal payment. I'm going to press pay. And actually, this business of us all just wanting the immediate payment, sometimes they aren't absolutely necessary. It's just like a habit. If you had to add up what you're paying for all those instant immediate payments, you might be a bit shocked. Yeah, it's a good exercise. Anyway, so So Jean says, quite understandably, ABSA has more than 5 million digitally active customers, including those doing internet banking. Imagine how much extra money they are reaping due to this default setting in their app. So yeah, it's a good question, and I took it to ABSA.
And what did they say?
I was really looking forward to the answer, because, as I say, I had the proof of what was going on. I couldn't think of why that could be happening when you think she's paying R6 more than she thought she was paying for every payment. The answer turns out to be, it had to do with the fact that she was using the old bank app versus the new one, which I don't think she would be alone in that, not by a long chalk. Responding on behalf of ABSA, Keenan Mayet, who heads up the bank's retail, international banking and payments division of personal and private banking, told me, we investigated and discovered that John was using an older version of the ABSA banking app. The latest version, 7.4.2.4, we want to know, includes improvements that enhance the payment flow that she referenced. These updates strengthen customer control and clarity when selecting between PayShap and normal EFTs. An on-screen notification confirms that the transaction is instant, with the option to cancel and choose a different payment method. The notification also displays applicable fees clearly to a customer before a transaction is concluded. We will continue to support our customer to ensure that she is comfortable with the payment options and that her selections fully reflect her intent. Incidentally, here's what Jean had to say about all of this.
Yesterday, I received a call from an ABSA representative who asked me to update my app. Once I had done this, I was keen to try the app again and see if it still defaulted to PayShap. This time, it still did. The only difference is that there's now a list of payment methods, and at the bottom, a line that reads instant payment information and fees. You need to click on the I next to that and then scroll down through a menu and again click another arrow that says view the fees before you actually see what the fees are. So unfortunately, the app still defaults to PayShap, and I didn't find the fees clear at all. The only reason why I knew that they were there was because I had been through this experience with the bank's representative. Before PayShap, the bank had a system where if you clicked on immediate payment, it would always tell you that you were going to pay higher fees, and they can definitely do that again to improve the system.
Yeah, I know. I think it's one of those things that we still need to look closer. Yes, there's all this convenience that comes with the apps and making sure that you can send money almost instantly. Obviously, that comes at a price, but I also think it's still the bank's responsibility to communicate that if you have an older app, it might just take you automatically by default, charging you R6 more for a service you normally pay R1.50. I think it's another lesson here, Wendy, for us to look closer as we use this technology.
Absolutely. And just, for those ABSA clients who are using the old app to be aware of this, because I'm very much doubt that John would be the only one that's had this happen to her. So I also wanted to know, and I haven't given them enough time to answer, admittedly, but the main thing, I just want to get the warning out. But I asked the bank, when did they make the latest version of this app available for downloading by their clients, and what percentage of their 5 million plus digitally active customers are still using the old one, possibly not realizing that their regular payments automatically become more expensive than the PayShap ones. So as I say, they haven't got back to me. And also, I thought to ask, and the answer is, I haven't got it yet, is will ABSA be refunding the fee difference to those who actively chose normal payments and then had that choice automatically deselected and selected in favor of their more expensive PayShap immediate payment? I suppose that depends on whether there's digital proof of that. I mean, the systems must have it.
Yeah, if you kept proof, screenshots and things like that. But I think the homework now lies with us as consumers and those that use the ABSA app as well. That was our consumer ninja, Wendy Nola, talking to us about banks charging you extra without you knowing when you press that immediate payment.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
Let's look at how the markets ended the day. Then today, the all share up 496 points. Industrials up in positive territory, but it was the banking stocks that were up more than 1% today that pushed up the local JSE. Pepco up 3.9%. Exxaro enjoying gains of 3%. ABSA up 2.5%, with Pan African Resources up 2% on the day. The rand at this hour, 17.03 against a weaker dollar. Of course, jobs numbers not hitting the right numbers in the US. So at 17.03 against the US dollar, 19.86 against the euro, and at 22 rand 71 cents against the British pound. Price of gold at $4,205 an ounce, or platinum is at $1,647. Brent crude was at $62.67 a barrel.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
We were set to bring you Business Unusual here on The Money Show, but having a little trouble then out in Las Vegas, talking to Arthur Goldstuck, of course, at that AWS conference, where a new technology, AI, and the future of the sector being discussed there. The conference set in Las Vegas, the Amazon services, web services, was set to come out today, and we're going to get Arthur Goldstuck to give us the latest out of Vegas. But because we can't connect to him tonight, we're going to be playing you How to Resign Gracefully and Why It's Important for Your Career with our guest Advaita Naidu, the MD for Africa at executive search firm at Jack Hammer Global.
The Money Show.
Business Unusual.
Well, the question tonight in Business Unusual, how do you resign elegantly? We've sort of heard how not to do it. Advaita Naidu is Africa MD at Jack Hammer Global. Advaita, you sort of sparked a conversation. A lot of people are quite keen when they resign, or maybe they've been forced out, to go in a sort of blaze of glory. I know you're sensible and rational, and you're going to advise us not to do it.
It's amazing, though, how many sensible and rational people can let emotions take over them at this one critical moment, though, isn't it? But I think how you leave is as important as how you performed when you were with the company and as where you're going next. It can be a bit of an inflection point, a defining point in your professional narrative, because the way you do it will say whether you have the emotional intelligence and the good reputation and maturity, but it is kind of like hygiene factor. When you do it well, it's normal, and when you do it badly, it's noticed.
I mean, I have seen some people leave a company with real class, and that left a real impression. Does how you leave almost as big as an impression as how you were at a company?
I think it does, and I think when people do it in a way that's clear, they have a calm and an intentional conversation about their decision, and importantly about the fact that they're not going to be open to a counter offer. It doesn't, open up any messiness. They do it with a proper handover plan, and they promise that they're still going to remain engaged throughout their notice period, and then they have a bit of a closure. They end with gratitude and respect, regardless of their circumstances. I think it lands pretty well, because sadly, ultimately, people will remember the end a bit more vividly than the middle, and so it then just becomes part of your legacy. So it is incumbent upon you to do it well and do it properly.
Is it more important to do it well than it used to be because of our old friend social media?
Social media, yes. I think, you consider that we live in this hyper-connected world, so the rules are very different than they were in the past. Before, if you left a job badly, maybe 3 people would know about it, and today it can be 300 very quickly. But it's when you think about the hyper-connectedness, when you use social media, I think, there are people who will go onto LinkedIn and see that there's a mutual connection. A hiring manager will scan an online footprint and pick up a phone with a quick, how did this person leave? You worked with him or her, like what happened there? And these conversations are hugely influential. And other than resigning well and performing well, there's nothing that you can do to control for them, because they're informal, they're off the record, they can be quite candid. And so anyone who's witnessed a poor exit, and this isn't just colleagues, right? It's not colleagues, it's clients, it's suppliers. They could end up telling a story of that moment where you may not have shown up at your absolute best.
Yes, no, I mean, I think that makes a lot of sense. One of the other things that's changed, not just social media, Advita, obviously, is the exit interview. And exit interviews, I think, are very complex. In fact, we got a great voice note on 072-702-1702 about them.
Hello, Stephen. This is Lorraine from Cape Town. Anyway, I'm no longer in corporate, but I don't do exit interviews. I just refuse. It's just, for me, it's just a waste of my time, because I've moved on, and whatever that bothered me, I would have actually addressed prior for me moving on. So once I do resign, I don't do exit interviews. It's just really total waste of time. What is that they're going to change for me or for whoever that is going to be left behind? We can have an informal chat after I've resigned with whoever, but don't give me the exit interview.
It's an interesting point, Advita. I mean, if I'm leaving, why would you care what I think?
So a couple of things. I mean, I suppose it depends on why the person's leaving, and I think that's important. If there was a push factor out of the company, I think it's probably important for the people who are left behind, or if you plan to return at some point, that you can give some feedback if you're comfortable to do so. But this is not supposed to be a therapy couch. It's not at the time to go and verbally detonate and talk about all the ways in which you were mistreated or unheard. But if there is something constructive that you can share about process and workflow and cultural observations, and it still keeps that cap of professionalism on you, I think that's important. If it's emotional or personal, absolutely do not do it. And then if you think about if there's a pull factor for somebody outside of the organization, it's not that, I'm happy to be leaving where I currently am. It's just that there's a better opportunity for me elsewhere. That's also important for a company to know, especially a manager that you're leaving behind if there are no hard feelings.
So I get all of that, and it sounds a little HR, because I don't mean that in a bad way. AI is coming for you. But what I think that one of the reasons people leave a place is because they don't get on with their boss. And how do you say that? Because that boss might be responsible for 5 people leaving in a month, but no one's going to say it unless they can be honest. So, if they took your advice, which I completely respect, Advita, but they probably wouldn't say it. And so then for HR and for the company, an exit interview is kind of useless. It doesn't fulfill its purpose. And isn't that quite complicated? I think if you're not honest, then what?
Absolutely. But again, I think if you can make your point in a way that is divorced from the emotion and not have it be career damaging and not resign in a fit of emotion, where you've reached the point and you've reached it from a fairly intellectual perspective, and you can actually feel comfortable to give the feedback either to HR or in an ideal world with other colleagues or somebody who the manager reports to, I think that is quite important. And again, if there's a pattern, if an HR department is doing its job in the way it should be doing it, then they will start to notice that and they will act on that. Unfortunately, it's too late for the person who's leaving, but it could help to improve culture in the longer term. But unfortunately, there are also managers and leaders who receive resignations poorly. So considering there's an information and power asymmetry in this case, with you being the person resigning, it's still incumbent upon you to make sure you do it in a way that there's no blowback on you.
It's interesting that, because I think some people might feel the only time they can be honest about the company is just after they've resigned.
That is sad but true, but I think there's still a way to reinforce your integrity and go with grace and make sure that it strengthens your professional network in the longer term. So if you can give that feedback in a matter-of-fact, data-driven way, and again, divorce yourself from the emotion, that's the way to do it.
Advita Naidu, it's fascinating. Thank you so much. Really appreciate it. Africa MD at Jack Hammer Global.
The Money Show.
Shapeshifters.
Welcome back to The Money Show. Around this time on a Wednesday, we speak to a shapeshifter, any business person in any industry that has shown an ability to adapt to their conditions. And tonight we have a very interesting shapeshifter in FNB CEO Harry Kellan, who's joining us here in studio on The Money Show. Welcome to The Money Show.
Motheo, thank you for those kind words, and good evening to you and good evening to your listeners.
Now, I want to start with your story where you changed your degree. That's where I want to start, because I think that's where the trajectory changed for you into the role that you're in now of CEO. You could have been a doctor.
No, I don't think I was going to be good enough to be a doctor, but I didn't know back then. As a youngster, I didn't know that. I actually did not get into medicine. I applied. So then I took second choice was BSc and that whole trajectory of doing it. And after the first year of BSc, disappointing many people, but then I'm glad I changed to BCom and no regrets since then.
I was about to say, I mean, how many people did you have to explain to that you were not taking that route?
And mainly mum disappointing that not becoming a doctor, dad disappointing that I wasted a whole year of hard-earned cash, kind of thing. But yeah, it's mainly the family pieces. I think the friends said, yeah, it was obvious you should be doing BCom.
But all's well that ends well. I mean, you are the CEO of FNB today. But let's go back a little bit to Lenasia, where you were born and you grew up, what the community was like then, what type of parents you had, and some of the discussions you had at the dinner table that shaped the man you are tonight.
So my mum was a teacher, so she's late, so she was a teacher, but she was a grade 1, grade 2 teacher. So very hands-on, kind of nurturing individual as a teacher. My father was hairdresser for all intents and purposes, a barber, working out of Fordsburg and that. So the conversations around the table weren't necessarily business. Life, lots of it, not necessarily a business kind of discussion at the table. Whereas now I try and make sure that our dinner table isn't that much business either. You know, because life is multifaceted.
Yeah.
And the discussions around that. Yeah, so, and the community we grew up in, I mean, it was a entry-level house, don't come from a wealthy privilege, but I mean, you know, when you look at where South Africa is, and if you're coming from an okay middle class, you're privileged. So I always see myself as coming from a privileged household where education was valued and given me the ability to educate myself, and I think that's the biggest value that my parents had given me, is that opportunity to study. And as you would gather, as a teacher, she valued education significantly. I mean, when she was going to teachers' college, I have an elder sister, so family was looking after my sister. But I was like, I think I was a surprise. Come along, and I grew up with my grandparents in Durban from the age of 3 months till 4 years. So I'm actually quite lucky, because I ended up having so many people around me that were like, in my early life was like, I had like multiple mums and multiple dads, because my mother was the eldest and all her siblings were younger. So I grew up spoiled.
And as you were growing up as a spoiled young man, as you say, were you thinking of a career in banking at all, or were you thinking of yourself in a suit somewhere, or was it something that came later in life?
So I never saw myself banking, actually never. Not in the early days, to be honest. I think banking was when I started articles. In the young days, I think it was more, you know, in the community we grew up with, was if you're in the medical field, actually you've arrived. If you're going to be an accountant, or a CA, even wasn't even talked about as a CA. It was seen as an accountant. It wasn't seen as a prestigious career path kind of thing. So it was always kind of approach of, okay, you may be a little bit clever enough to work hard and you could maybe get into becoming a doctor, and it's always that kind of thing. So that was always at the back of your head. That's why you choose subjects like biology. So that business, no suits, actually came into mind when I was a kid.
Let's talk about then the decision you made to move into accounting. You then study accounting, and as you do articles, your career starts to shape. You go through various auditing firms as still a young person. And with banking, I imagine as you walk in, then you're walking in an environment where there's very older colleagues. And how do you carry yourself at that particular time and find a voice in that group?
So, I mean, the one thing you got to go is like, it's always your approach and attitude. I've always had an approach is, I don't have the answer to everything. I can be confident enough to ask the question, and the trick is actually not asking just for the sake of asking to actually learn and listen. And But I mean, I was fortunate as well to join Arthur Andersen. It was an American culture business as an auditing firm, but it was a small firm. It was one of the big five back then, but in terms of its intake, I think the Johannesburg intake, I was one of 20 first-year article clerks, and I think Durban, Cape Town would make it 30. So it was a small firm, but then you actually, so you might be one of 30 versus one of 100 makes a big difference sometimes. You get noticed differently around the piece. And yeah, you just got to learn, and it's the attitude of actually delivering. Yeah. And because it was an American firm, it was very harsh on output kind of thing. It was you deliver or you don't. And it's very known, very transparent, kind of thing where partners and managers kind of would see you as a ranking, not official ranking, but kind of thing. And then you get put on jobs, etc. So, again, I think it was more luck and privilege that I got put onto banking audits, stockbroking audits and that. And that was my start into financial services. And then financial services continued. I went to secondment to London, just short of 2 years, with Arthur Andersen. And that also was great because the things you learn is, South Africans still don't fully recognize that actually what we produce out of South Africa is very good quality.
Top talent.
Top talent. Across the spectrum.
Yes.
That's why we see so many doctors leaving. That's why we see so many management teams actually being asked to immigrate, etc., around the piece. And I mean, I saw that when I got to London, finished article 6 months later, seconded in June. You walk into the London office, and because Andersen was a worldwide, one single firm, same way of documentation, same system, same kind of processes. So I land there on a Saturday morning and I start working on a Monday morning, gone to a client after the first hours of HR doing the admin pieces. But what you realize is actually, we might be at the bottom end of Africa, but I could hold my weight with my fellow peers that were in the UK market and actually deal with clients, because now you're a senior, if you can put it that way, post articles and deal with issues. And then back then, the first job I remember was with a client that was thinking of converting to a banking business, to getting a banking license. And it was a debate whether you change from a advisory stockbroking business into a bank. And there I was, plunked into the team very quickly, and you sink or swim, and I swam well.
I think that was the general consensus then. Sink or swim, very harsh environment. How do you deal with the culture shocks at that particular moment? Are you rolling with the punches, or are you having to step back a little bit to just take a breather?
You actually got to be having a mindset of being adaptive. So the thing is, culture is a microcosm. So you could be talking to a group of friends, and let's say you got a group of friends from school. Your interactions will be different to the group of friends that you have from varsity. It'll be different interactions to the group of friends that you have from your first job or career, etc. And that's what human nature is adaptive to different kind of things. But you got to be willing to be adaptive. You got to be willing to say, okay, you got to roll with the punches. Nothing's going to be the same. There's no constant anything. Actually, change is a constant. And as I said, I always tease people when I talk to staff, and I go, I have one mouth, but I have 2 ears. So listening is a more powerful skill. It's 2 times the value of what you say. But why do you listen? Because actually, if you're never going to listen, you're never going to know what to adapt to or not learn, etc. around it. So yes, Motheo, rolling with the punches, any environment, stable or changing or harsh, you have to be able to be adaptive to roll with it.
I deliberately asked that question because at 35, you are Chief Financial Officer. A role some people would think even back then is more suited for somebody who was far older. But it was quite clear that as a talent then for FNB, you were someone they were willing to bank on.
Yes. I mean, the CEO back then was Michael Jordan. I joined FNB in January 2005. He became CEO of FNB in October 2004. And in my first 2 years as head of group finance for FNB, I had lots of interactions with him. And because I came from a corporate finance background, maybe I wasn't talking like a traditional finance person. And it was always about what is the stories behind the numbers and not the numbers itself. And I always, when I was in finance even back then, I used to tell people, give me insights. Don't give me the information, give me the insights. And it was early part of Michael's CEO tenure. So I was probably lucky enough to be at the right place at the right time. And then 2 years later, opportunity arose and he appointed me as CFO of FNB. And I remember questions people came in because he's saying, okay, you're now taking over a seat where you got your fellow peers that are much more experienced than you.
Yeah.
Much more experience in business, let alone experience from a tenure in role and home banking for that matter. You're inheriting a team on the finance piece that have been there longer in our business, some of them much older in age. And how are you dealing with that? How are you dealing with people working for you that are from a different level? So I go, no one works for me. I work with people. People work with people. There is no command control. Humans are not command control. People make it command control and they make a choice around it. And the fortunate thing is the group, FNB, has a very empowered culture. So as a young CFO then, I was empowered. In the role, empowered, etc. But also an empowered culture doesn't mean that you left alone and actually, if you don't survive, well, tough. It's actually empowered together with, we're working as a team. So it's not just empowered and says, run and you're going to sink or swim, in my previous analogy, but actually we work together. But yeah, so the trick about age is not relevant. And yeah, sometimes people that actually you're working with are much more experienced with you. But that's good, because then you have knowledge that you could lean on, ask. The trick is always be happy to ask. Most people get to the point where if I ask this question, maybe I don't look as clever as people think I am. Doesn't matter. It's not about clever. You got to be able to actually solve. Business is talking about solving things, figuring out what customer needs are, solve for customer needs. If you're never going to ask, you're never going to know.
We'll get more gems then from the FNB CEO Harry Kellan. He is our shapeshifter tonight.
The Money Show, Stephen Grootes, is brought to you by Absa CIB. Discover the latest trends shaping digital assets across Africa. Download the Absa Africa Digital Assets Insights 2025.
The Money Show.
Shapeshifters.
And our shapeshifter tonight is FNB CEO Harry Kellan, telling us about his story throughout his finance career, joining FNB in 2005, 2 years later at the age of 35, becoming the CFO. You once got an award at the CFO Awards. You won the Compliance and Governance Award. And there you talked about leadership not being about a title or designation. What has been your leadership style since you've taken up these various roles?
So, and I've seen it sometimes, young leaders get into a seat and they feel like they've got to prove themselves. And I always remind people to say, the role is yours already. Okay, so you don't have to prove yourself. In which case, actually, and the trick with leadership is, and as I alluded to early on, is people are not expecting you to have the answers to everything. Okay, so don't assume that you've got to tell people to do A or B or etc. Yeah, that may be more of a management style, but of leadership is actually leading other managers, and ultimately you're leading other leaders. And the environment makes a difference as well. So as I said, I think I was lucky to land up in FirstRand. So an empowered environment actually nurtures much of that. And my style is actually, the saying goes, surround yourself with people more better, cleverer than you are. Agree on the direction, agree on the strategy, and then stay out of the way. But it doesn't mean that you're not there. It's not there that, so leadership's about trust as well. So I always tell my team, I have your back. Don't stress. Part of business is failure. You got in, people will, if you're not willing to fail, you're not willing to learn. If you're not willing to learn, we'll never be innovative. You will never change things. So it's okay to fail. Intent matters. I've never seen anyone that has an intent to fail, because then I would say that's sabotage. So actually, and if there's failure, great. Assist, help, lean in when it's required to be. But it's not expected that you've got to do do it for them and tell them how to do it, step A or B or C. There is requirement sometimes. Someone comes to you and says, okay, I'm battling with A, B, and C. Then that's like whiteboarding kind of thing. You might not know the answer, but in conversations, you toss a couple of ideas kind of thing. But yes, I mean, the biggest thing about leadership is actually supporting the team, making sure that, but it doesn't mean that necessarily you can't have tough conversations. Being a leader, there are times that you've got to have a very straight and tough conversations. And again, it's not a tough conversation playing the person. It's always about playing the ball. So it's not, and you can be different. You can have the same conversation about the same issue.
Yeah.
The person walks away feeling very disengaged or disempowered or feeling like, oh, hold on, I'm being shut down as a person. Or rather, same conversation, deal with the issue. The person will learn from it, you'll learn from it, and actually solve. And it's that attitude and approach of how you deal with it. That's what I was saying.
It's never personal.
It must never become personal.
The FNB you joined in 2005 went on to be quite aggressive on innovation, willing to fail in terms of introducing tech to clients, and they've done quite well over the years. You now take over that FNB that is in fact the best innovative bank. Where do you think you want to lead the bank going forward?
So fundamentally, we are still very innovative, but we don't do innovation for the sake of innovation. So it's what's the purpose of the business? And the purpose of what FNB has always been was help. And we recognize that we're actually in the middle of the economy and we're here to serve society. And we serve customers across the spectrum of society. So you could be an entry customer, early age, or early new work, all the way up to an FNB stops at mid-corporate, large commercial businesses. And then at a given point in time, it's a corporate business that will then be dealt with RMB, which is dealing with investment banking piece, corporate transactional pieces. But our spectrum is quite wide. So even at the individual level, you've got an entry person that maybe could be earning, say, 2,000 or 3,000 in a month, or you're dealing with an ultra high net worth individual, but you're still serving society in its full diverse form. And we've always stood for help. So how can we help you has been FNB's actual purpose. And it's one of those things that it's a high bar, but it's a good bar because actually it forces you to always say you are doing something for people. So again, the innovation piece comes to what are the pain points for our customers? What are their needs? Sometimes we got to preemptively see needs even before. So we were the first to come with cell phone banking. We were the first to come with the FNB banking app in this market. But at that point in time, none of that was in the market, but you got to actually think is what you're trying to solve. Cell phone banking was like in 2006. We still offer that as USSD. And that was to be able to serve wider community of people, giving them an early part of digitization where it was difficult to get to them in areas or actually expensive to serve. And it was a specific need that we were trying to solve for a wider set of populations of South Africa.
Great future then for FNB under your leadership, Harry Kellan, the FNB CEO, our shapeshifter tonight, telling us about his journey throughout his career in banking and finance.
The Money Show, Stephen Grootes, is brought to you by Absa CIB. Discover the latest trends shaping digital assets across Africa. Download the Absa Africa Digital Assets Insights 2025.
That was the Money Show tonight. A great conversation we've had there with the FNB CEO, Harry Kellan, our shapeshifter, talking to us about the changing landscape of banking, some interesting leadership styles that are far, far better for the modern age, if you ask me, because if a leader can tell you that he's got your back, you'll definitely do your best. Join us tomorrow night as we chat money once again on The Money Show.